Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Understanding Credit Default Swaps. For investors and financial pros, understanding CDS can be a game changer. These swaps can manage risk, speculate on credit markets, or enhance returns. In an ever-volatile financial landscape, knowing how CDS work can give you a leg up on making smarter investment decisions. Stay tuned to learn the ins and outs of this crucial financial instrument. What is a credit default swap, CDS? A credit default swap, CDS, is a financial agreement that works much like insurance for investments. It's designed to protect lenders from the risk of a borrower defaulting on their debt. Let's break down what CDS are, explore their history, and identify the key players involved. Definition and basic structure. A CDS is a contract between two parties, the buyer and the seller. The buyer pays a regular fee to the seller, similar to an insurance premium. In return, the seller promises to compensate the buyer if a specific debt issuer defaults on their payments. Here's how it works. Buyer pays periodic fees. Seller agrees to pay off the debt if the issuer defaults. Issuer, the entity whose debt is protected under the CDS. Imagine you're a bank that lends money to a company. You're worried the company might not repay the loan. By purchasing a CDS, you ensure that if the company defaults, the CDS seller will cover the loss. This way, you transfer the risk of default to the seller. Historical context. Credit default swaps originated in the 1990s and became popular in the early 2000s. Initially, they were tools for large financial institutions to manage risk. Over time, their use expanded and they became key players in the financial markets. Key milestones in the history of CDS include 1994, JP Morgan developed the first CDS to manage credit risk. Early 2000s, rapid growth in the CDS market as more institutions adopted them. 2008, financial crisis CDS were heavily scrutinized. Some believed they contributed to the crisis by amplifying financial risks. Despite the controversy, CDS continued to evolve and remain essential in today's financial landscape. Key players in CDS market. The CDS market involves various participants, each playing a crucial role. Understanding who these players are can provide insight into how the market functions. Insurers, these are usually large financial institutions or specialized firms. They sell CDS contracts and take on the risk of defaults. Banks both buy and sell CDS. They use them to manage the risk of their loan portfolios. Investors. Hedge funds, pension funds, and other institutional investors often buy CDS to hedge against potential losses or speculate on credit events. Corporates. Sometimes companies themselves use CDS to ensure their debt obligations. Each participant has distinct motives and strategies when it comes to engaging in the CDS market. Understanding these elements of a credit default swap can help anyone grasp why they are vital tools in the financial sector. Be sure to dive deeper into each aspect to get a full picture of how they operate and influence modern finance. How credit default swaps work. Understanding how credit default swaps, CDS, work involves looking into their mechanics, premiums, payouts, and real-life applications. This section breaks it down for you. Mechanics of a CDS. A credit default swap, CDS, involves two main parties, the protection buyer and the protection seller. Here's a closer look at their roles. Protection buyer, this is the party that's seeking insurance against default. They pay a regular fee or premium to the seller. Protection seller, this party provides the insurance. They receive the premium payments and agree to compensate the buyer if the debt issuer defaults. In essence, a CDS contract works like this. The buyer pays regular premiums to the seller. If a default event occurs, the seller must compensate the buyer for the loss. Think of a CDS like a bet on whether a company will repay its loan. The buyer bets it won't, and the seller bets it will. If the company can't pay back its debt, the seller covers the loss. Premiums and payouts. Premiums and payouts are crucial components of CDS. Here's how they work. Premiums. The buyer pays the seller a regular fee, similar to an insurance premium. These payments are usually made quarterly. The amount of the premium depends on the perceived risk of default by the debt issuer. Payouts. If the debt issuer defaults, the seller must compensate the buyer. This compensation can be in the form of physical settlement. The buyer delivers the defaulted bond to the seller, who pays the buyer its face value. Cash settlement. The seller pays the buyer the difference between the bond's face value and its market value post-default. For example, if a company defaults and its bonds drop in value, the seller pays the buyer the difference, covering the loss. Example scenario. To make this clearer, let's walk through a real-life example. Initial setup. Imagine you are an investor who owns $1 million worth of bonds issued by company XYZ. You're concerned about XYZ's financial health, so you purchase a CDS from an insurer. Premium payments. You agree to pay the insurer a premium of $10,000 per quarter. Default occurs. 1 year later, company XYZ defaults on its bonds. The market value of the bonds drops to $300,000. Payout. Because you have a CDS, the insurer compensates you for the $700,000 loss, either by buying the bonds from you at face value, physical settlement, or paying the difference in cash settlement. This example shows how a CDS can protect investors from significant losses due to defaults. By transferring the risk to the seller, you can safeguard your investment. In summary, understanding the mechanics, premiums, and payouts of credit default swaps, as well as seeing them in action through an example, can illuminate how these financial instruments function in the market. Types of credit default swaps. Credit default swaps, CDS, come in different forms, each with its own features and uses. Let's explore the main types of CDS so you can understand their unique characteristics and how they fit into the financial world. Single name CDS. Single name CDS are designed to cover the credit risk of a single borrower. Think of it as taking out insurance on one specific company or entity. Here are the key characteristics. Specific borrower coverage. Single name CDS protects against the default of a single entity. For instance, if you're worried about company XYZ going bankrupt, you'd buy a single name CDS on their debt. Premiums and payouts. You pay regular premiums to the seller and they promise to cover the loss if that specific borrower defaults. Direct risk management. These CDS are perfect for investors who want to manage the risk of a particular loan or bond. A single-name CDS provides a straightforward way to hedge against the credit risk of a specific company or government entity. Index CDS. Index CDS offer a way to manage the credit risk of a group of borrowers. Instead of focusing on a single entity, these swaps cover a basket of different borrowers. Here's why Index CDS can be advantageous. Diverse exposure. By covering multiple borrowers, Index CDS spread out the risk. If one borrower defaults, it's less likely to have a huge impact on the whole basket. Standardization. These swaps are usually based on well-known credit indices like the CDX or iTraxx. This makes them easier to trade and more liquid. Efficient risk management. Index CDS are great for investors who want to manage broader credit risk or gain exposure to a specific sector without having to buy multiple single-name CDS. Think of Index CDS like a mutual fund of credit risks, giving you peace of mind through diversification. Tranche CDS. Tranche CDS takes the concept a step further by dividing the credit risk into different levels or tranches. Here's what you need to know. Risk segmentation. The credit risk is split into different layers, with each tranche having a varying level of exposure. Senior tranches are safer, while junior tranches carry higher risk. Customized protection. Investors can choose which tranche to invest in based on their risk appetite. Safer tranches have lower returns but more protection, while riskier tranches can offer higher returns. Complex structure. These can be more complicated to understand and trade, but they offer tailored risk management for sophisticated investors. Tranche CDS act like a layered cake, where each slice represents a different level of credit risk. This allows investors to pick the piece that best suits their risk tolerance. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.